$8 trillion just vanished from the American economy in 72 hours. Not gradually, not over months, not through some slow, predictable decline. $8 trillion erased from stock markets, retirement accounts, pension funds, and savings portfolios in 3 days. And the people who caused it are now telling you everything is fine. Here's what actually happened. Between Monday morning and Wednesday close, the S&P 500 dropped 12.4%. The Nasdaq collapsed 15.7%. The Dow Jones Industrial Average shed over 4,800 points. Combined market capitalization losses across all U.S. exchanges exceeded $8 trillion. That's not a correction. That's not a pullback. That's a financial earthquake that just destroyed more wealth in 72 hours than the entire GDP of Japan. Let that sink in. $8 trillion gone, deleted from the system like it never existed. Your 401k lost money. Your IRA lost money. Your pension fund lost money. Your company's stock options lost money. If you have any exposure to the American financial system whatsoever, you are poorer today than you were on Monday morning. And the people responsible for this catastrophe are currently on television telling you to stay calm and keep your money exactly where it is. The immediate trigger was Trump's announcement of sweeping new tariffs, a 25% blanket tariff on all Chinese imports, a 15% tariff on European Union goods, a 10% baseline tariff on imports from every other trading partner. Total estimated tariff revenue, $780 billion annually. Total estimated damage to global trade flows, incalculable. Markets didn't just react. Markets panicked. Circuit breakers triggered twice on Monday. Trading was halted on 847 individual stocks on Tuesday. Wednesday saw the highest volume selling day since March 2020, when COVID shut down the global economy. But here's what makes this crash different from every crash that came before it. This one was entirely self-inflicted. Nobody invaded anyone. No pandemic emerged. No financial institution collapsed. No terrorist attack disrupted global confidence. One man made one announcement. An $8 trillion disappeared. Federal Reserve Chairman Jerome Powell appeared at an emergency press conference Wednesday afternoon. He described the market situation as reflecting uncertainty around trade policy adjustments and emphasized that the underlying economy remains fundamentally strong. But here's what Powell didn't say. He didn't say that the Federal Reserve has no tools to counter a trade war. He didn't say that interest rate cuts cannot fix supply chain disruptions caused by tariffs. He didn't say that inflation, which was already running above target at 3.8%, will accelerate dramatically as tariff costs are passed directly to American consumers. He didn't say that the bond market is already pricing in a recession within 6 months. He didn't acknowledge that foreign central banks dumped $42 billion in U.S. Treasury bonds during the sell-off, the largest 3-day foreign liquidation of American government debt in recorded history. Either Powell genuinely believes the economy is fundamentally strong, while $8 trillion evaporates, and foreign governments flee American debt, which means he's disconnected from reality. Or he knows the situation is far worse than he's admitting, and he's deliberately misleading the public to prevent further panic, which means the Federal Reserve itself has become a source of systemic risk. Both scenarios should terrify every American who has a savings account, a retirement plan, or a paycheck denominated in U.S. dollars. And it gets worse. The $8 trillion headline number actually understates the real damage. That figure only counts publicly traded stocks. It doesn't include the losses in corporate bond markets, where investment-grade spreads blew out by 87 basis points in 3 days. It doesn't include the losses in real estate investment trusts, which dropped an average of 18%. It doesn't include the losses in cryptocurrency markets, where Bitcoin fell 22%, and the total crypto market cap shed $640 billion. It doesn't include the losses in private equity portfolios and venture capital valuations that haven't been marked to market yet, but will show catastrophic declines when they do. The real number isn't $8 trillion, it's closer to $12 trillion in total wealth destruction across all asset classes. And counting. Treasury Secretary Scott Bessent appeared on CNBC Thursday morning attempting damage control. This is a healthy repricing of risk, he said. Markets were overvalued. This correction brings valuations back to sustainable levels. Long-term investors should view this as an opportunity. Translation: we broke the market on purpose, and we're pretending it was a good idea. Please keep your money in the system so the people who got out before the crash don't lose their exit liquidity, because that's exactly what happened. Let me show you the data that Wall Street doesn't want retail investors to see. SEC filings published Wednesday evening reveal that in the 2 weeks before Trump's tariff announcement, corporate insiders at S&P 500 companies sold $9.3 billion worth of their own company stock. That's the highest level of insider selling since records began being tracked in 2004. CEOs, CFOs, board members, and senior executives dumped shares at a rate 3 times the historical average. They knew, they were briefed, they were warned, and they sold before you could. When corporate insiders sell $9.3 billion in stock 2 weeks before a policy announcement that erases $8 trillion in market value, That's not coincidence. That's not prudent portfolio management. That's a transfer of wealth from ordinary Americans to the people who had advanced knowledge of what was coming. Financial journalist Nomi Prince, former managing director at Goldman Sachs, posted an analysis Thursday morning calling the insider selling pattern unprecedented in scale and timing. This is the most obvious case of asymmetric information advantage I've seen in 30 years of covering financial markets, she wrote. Retail investors were the last to know, and they'll be the last to recover. Economist Peter Schiff, who famously predicted the 2008 financial crisis, was even more blunt. This isn't a market crash, he said on his podcast Thursday. This is a wealth confiscation event. The money didn't disappear. It transferred from people who didn't know what was coming to people who did. Even Mohamed El-Erian, chief economic advisor at Allianz and one of the most respected voices in global finance, expressed alarm. The speed and magnitude of this sell-off suggests something beyond normal market repricing, he told Bloomberg. The structural damage to investor confidence could take years to repair, regardless of what happens with tariff policy going forward. 3 experts, 3 different backgrounds, all saying the same thing. This crash wasn't an accident. It was a predictable consequence of policy decisions that insiders knew about in advance. And ordinary Americans are the ones paying the price. So where does this leave your savings? In more danger than at any point since 2008, and possibly more danger than 2008 itself. Here's why. In 2008, the Federal Reserve had room to cut interest rates from 5.25% to 0. That monetary cushion allowed the Fed to flood the system with cheap money and stabilize markets within 18 months. Today, the Fed funds rate sits at 4.5%. Cutting to 0 would provide some relief, but nowhere near enough to offset the combined damage of a trade war, accelerating inflation, and foreign capital flight from U.S. assets. In 2008, the U.S. government could borrow massively to fund stimulus programs because the national debt was $10 trillion and debt to GDP was 64%. Today, the national debt exceeds $36 trillion. Debt to GDP has surpassed 125%. The government's ability to borrow its way out of a crisis has been severely compromised. Every additional trillion in deficit spending accelerates the timeline toward a sovereign debt crisis that makes this week's stock market crash look like a rounding error. In 2008, the US dollar was the undisputed global reserve currency with no serious competitors. Today, BRICS nations are actively building alternative payment systems. China has internationalized the yuan through bilateral trade agreements with over 40 countries. Central banks worldwide have been reducing dollar reserves and accumulating gold at the fastest pace in 55 years. The dollar's safe haven status, the one thing that has always protected American savings during global crises, is being systematically dismantled. And Trump's tariffs just accelerated all 3 of these structural vulnerabilities simultaneously. The tariffs will increase inflation by an estimated 1.2 to 2.4 percentage points over the next 12 months, according to models from the Peterson Institute for International Economics. That means the $100 grocery bill you paid last month becomes $104 next month. Your $1,500 monthly rent becomes $1,160. Your car insurance, your utility bills, your prescription medications, everything gets more expensive while your savings account earns 4% interest on money that's losing 6% in purchasing power. That's not saving. That's losing money slowly enough that you don't notice until it's too late. Meanwhile, the people who saw this crash coming have already moved their wealth into assets that benefit from exactly this scenario. Gold has surged past $3,500 per ounce this week. Silver jumped 11% in 3 days. Physical precious metals dealers are reporting their highest sales volume since the COVID crash. Bitcoin, after its initial decline, has begun recovering as institutional investors rotate from dollar-denominated assets into decentralized alternatives. The smart money isn't panicking. The smart money already moved. The question is whether ordinary Americans will figure out what's happening before their savings lose another 20, 30, or 40% of their purchasing power. And here's the part that nobody in Washington wants to discuss publicly. The tariffs aren't temporary. Trump's team has explicitly stated that these trade measures are permanent structural adjustments to the American economy. This isn't a negotiating tactic that gets reversed when a deal is reached. This is a fundamental reshaping of global trade that will increase costs for American consumers and businesses for years, if not decades. That means the market losses aren't temporary either. Companies that derive significant revenue from international trade will see permanent earnings reductions. Supply chains that took 30 years to build will take a decade to restructure. Consumer prices that rise due to tariffs almost never fall back to pre-tariff levels, even if the tariffs are eventually removed. The $8 trillion that vanished this week isn't coming back. Not all of it. Not quickly. And possibly not ever for investors who stay in the same positions that just destroyed their wealth. Today, the market's lost $8 trillion. Or tomorrow, the economic data starts reflecting the real-world impact of tariffs on businesses and consumers. Next month, Earnings reports will show the first wave of corporate profit declines. Next quarter, layoff announcements will begin as companies cut costs to offset tariff-related margin compression. By year-end, the recession that bond markets are already pricing in will be visible in every economic indicator that matters. And through all of it, your savings will be sitting in the same banks, the same retirement accounts, the same financial instruments that just demonstrated they can lose a decade of gains in 72 hours. That's not a market correction. That's a warning. The $8 trillion wasn't just deleted from stock tickers and portfolio statements. It was deleted from retirement timelines, college funds, home down payments, and emergency reserves that real families depend on for their financial survival. And the people who deleted it are sitting in offices in Washington and on Wall Street telling you to stay calm while they've already protected their own wealth. That's not a financial system working as designed. That's a financial system designed to work against you. And tonight, as markets prepare for another trading session that could erase billions more, the only question that matters is whether you'll keep trusting the same system that just vaporized $8 trillion of American wealth in the time it takes to binge watch a Netflix series. Based on what happened over the last 72 hours, the answer to that question could determine whether your savings survive the next 12 months or become another casualty in a crisis that Washington created and Wall Street profited from. The $8 trillion is gone. The question now is whether your savings are next. And based on everything the data is telling us right now, the honest answer is yes, unless you act before the next wave hits.